Hi, I'm Dr. Victoria Cloud, and I'm here to explain some accounting. In this video, we're looking at the preparation of a cash flow statement using the direct method. The direct method is the most common method used by Australian companies, and it comes as a legacy of a long period of having the direct method as mandatory. Only recently, there was a allowed choice of preparing this cash flow statement under the direct or indirect method. This cash flow statement is prepared under IFRS, although be aware that in IFRS, there's a lot of choice in terms of the sections that a particular cash flow item could go into, for example, into operating, investing, or financing. For the purposes of simplification, in this video, we're following the US GAAP treatment, where those items have some choice. We've just put them into operating, investing, and financing based on what US GAAP would say. I've put a link in the description of this video to an Excel file for a template and also a copy of the solution. So you can follow along with this video step by step.
Derby Limited, starting with the operating cash flow section. The two most common cash flows in operations is receipts from customers and payments to suppliers. So this is where we start. We start firstly with receipts from customers. We're going to use information from the balance sheet and the income statement that's provided in the question. Receipts from customers, we need to construct tier accounts, which we can find in the balance sheet, accounts receivable, because all our sales are on credit, and allowance for doubtful debts, which tells us whether there's been any actual write-offs during the period. So we're going to set up these two tier accounts first to help us to calculate receipts from customers. So let's label them up: accounts receivable and allowance for doubtful debts. Accounts receivable, we can put in the opening balance on the debit side. It's an asset, it's debit natured. Where do we find that opening balance? It comes from the balance sheet. So opening balance on the debit side, 128. The closing balance, we're going to put that on the credit side, 145. Allowance for doubtful debts, it's a contra asset, so it's credit natured. We're going to put the opening balance on the credit side, 12, and the closing balance on the debit side, 16. So we want to solve, first off, have there been any actual bad debts during the period? So on the income statement, we can see if there's been any write-downs in terms of, on the income statement, it tells us that there is, that we provided. In the income statement, it says we provided for bad debts of 15. So these are not the actual write-offs, but they help us to determine the actual write-offs of accounts receivable if they've happened during the period. So we'll put into the credit side 15 for bad debts expense, which is just a provision. It just tops up the account based on an estimate of how many customers will go bad. So we can total up the credit side of allowance for doubtful debts T account to be 27, which would be equal to the debit side 27. So we can determine, is there any missing amount on the debit side? So the closing balance is 16, and that debit side should total to 27. So we have had some actual write-offs. That's the missing amount. So we can put in accounts receivable of 11 into the debit side. That means we will have a corresponding write-down on the credit side of accounts receivable. So let's write that in 11, and that comes from allowance for doubtful debts. So what are we going to have on the debit side of accounts receivable? Well, we put in the opening balance. We then put in sales. So the sales come from the income statement. So that's 1,520. That's everything on the debit side. So we can total that side up to 1,648. The credit side will be equal to 1,648 as well. So now we can solve for the missing amount, which will be receipts from customers. So we take that, the total of the credit side should be 1,648, and we take away the closing balance, 145, and we take away the allowance for doubtful debts, 11. So this solves for the missing amount of cash, which will be 1,492. So this is our receipts from customers. Will be the first line in our cash flows from operations in our cash flow statement. Now we can move to the second most common cash flows in operations. This is payments to suppliers. So payments to suppliers, we're going to have two T accounts. So we can set these up, inventory and accounts payable. We have these two accounts because in these questions, all of our purchases are of inventory. That's one assumption we have. And the other assumption that we've got is that all purchases are on credit. So that means they're all going to go through the accounts payable T account. So let's construct the inventory T account first to determine how much purchases we had during the period. So we're going to put in the opening balance of 190, then the closing balance of 175. So they come from the balance sheet. We need to determine how much inventory we purchased. That will appear on the debit side of the T account. To solve for this, we need to solve the credit side of the T account. So we don't know how much we purchased during the period, but we do know how much we sold. So we can put in from the income statement, cost of goods sold, 1,110. Then on the debit side, we can now solve because we can total the credit side to be 1,285. So the debit side should be equal to that. So minus the opening balance 190 gives us our purchases of 1,095. We can then take those purchases to the credit side of accounts payable. And we can open the accounts payable T account by putting in 51 as opening balance and 87 as closing balance from the balance sheet. Then we can put in on the credit side those purchases made during the period that we've just solved from the inventory account. So now we can total up our credit side. This will come to 1,146. Then we can minus the closing balance on the debit side to solve for the missing amount. This will be our payments to suppliers. So we solve, and this comes to 1,059. We can then put this into our cash flow statement as well. So the line will be payments to suppliers 1,059. So in our income statement, I can see as well, we're going to have some receipts of dividends. So that's for cash. There's no accrual account, no need to adjust. So we can put this in as well into our cash flow statement. So receipts from dividends of 5. Now what we want to do is go through the income statement and look for if there's any accounts that have a matching accrual account in the balance sheet. That accrual account could be a prepaid or a payable, and we need to match those up to determine if we have any cash flows during this period. Where we don't find any matching items in the balance sheet, this must mean that the item is for cash. So it's all about matching to the balance sheet the income statement items. If you can't find a matching item in the balance sheet, then record it directly to the cash flow statement. So we're going to calculate our other expenses, and we always link other expenses to accrued expenses. Other expenses is a sundry amount of expenses, just little tiny expense items. In a real company, we would know what these are. They'd be like rent expense, wages expense, but we just add them all together. So something important that we can see in the income statement is that we don't have a separate line for depreciation expense. Now, depreciation is a non-cash amount. This means that we need to remove it from other expenses before calculating any cash flows with other expenses, because depreciation does not represent cash. So how do we remove depreciation from other expenses? Well, we need to calculate it. There's two methods for calculating this depreciation. There's the shortcut method, which is the closing balance of the accumulated depreciation minus the opening balance of that accumulated depreciation. The long way is to do the T account for accumulated depreciation. So the shortcut has a rule that for that non-current asset, you can only do that rule if there's been no sales and no revaluations. That's because sales and revaluations result in a decrease in accumulated depreciation, and that will prevent us from being able to do the shortcut of the closing minus opening balance. So it wouldn't calculate properly. So what we need to look at is for our two non-current assets in this question. We've got buildings and equipment. We need to look in the additional information and see whether there's been any write-downs or any sales during the period. And so for buildings, yes, that's the case. We have had a sale. Equipment, there's been no sale. So equipment, we can do the shortcut, which is the closing balance 214 minus opening balance 149. So this gives us depreciation expense of 65. Whereas the buildings, on the other hand, we would have to do the long way because it's had a write down. So what we would do is we're going to set up the T account for accumulated depreciation buildings. We put in the opening balance of 81 and put that on the credit side, and on the debit side we put the closing balance 75. So we need to calculate the missing amount of depreciation on the credit side, and we're going to put in the write down based on the sale. So we had a sale of buildings and we wrote down accumulated depreciation 43. So we can total up the debit side to be 118, and this will be equal to the credit side. So minus the opening balance gives us depreciation expense of 37. We can also verify the accumulated depreciation equipment T account by writing it in full. So we put in the opening balance on the credit side 149, and then the closing balance on the debit side 214. The difference between the 214 and the opening balance 149 gives us depreciation expense of 65. So now we've got the two amounts of depreciation, we can add them up. So 37 plus 65 gives us 102 depreciation. So now we need to calculate other expenses net of depreciation. So from the income statement, our other expenses is 198 minus this depreciation of 102 gives us 96. So we go now to the accrued expenses T account. We can put in the opening balance on the credit side of 11, the closing balance 27 on the debit side. We're going to solve for the amount of cash paid, which will sit on the debit side. We put in from our calculations the 96 of other expenses net of depreciation. So the credit side comes to 107 and the debit side comes to 107. So 107 minus the closing balance of 27 gives us cash of 80. So cash paid for other expenses, 80. We can put that into our cash flow statement. So payments for other expenses, 80. So income tax, there is a matching balance sheet item of income tax payable. So this means we need to construct the T account. So we put in the opening balance, 23 on the credit side, the closing balance 15 on the debit side. So the expense from the income statement is 67. So we can solve. The credit side will be equal to 90 and the debit side will be equal to 90 as well. So 90 minus 15 gives us cash paid for income tax of 75. So we can also have a look, do we have any expenses that do not have a matching accrual account on the balance sheet? So we can have a look, and there's no interest expense. There's no prepaid interest, no interest payable. So that means interest expense is going to go straight to the operating cash flow section. So we can write in payments for interest expense 25. So what about insurance? Is there any prepaid or payable insurance? And the answer to that is no. So we can take the insurance straight to the cash flow section as well. So payments for insurance, 9. So we can now add up, we've got all of our cash flows. I know this because I can tick off all of the items on the balance sheet and all of the items, all of the current asset and current liability section in the balance sheet, and I can tick off all of the items in the income statement. So we can total up our cash flows from operations, and this comes to 249. So next we can move to the investing activity section. The investing activity section, we're interested in the purchase or sale for cash of non-current assets. So the first thing to look at is the balance sheet, and we want to look at all of our non-current assets and see if there's been any increase or decrease, and we're going to match that together with the additional information. So we can look at land first off, and we can look at the balances. So the balance of land has increased over the period from 149 to 172. So we need to investigate the additional information. So the additional information, we've got a parcel of land with an original cost of 60,000 was disposed of. So that means we've sold it. So we need to determine, have there been any proceeds on this sale? So we need to calculate using the journal entry for the sale of land. So we can reconstruct this entry. So the first line will be debit cash. We can leave a missing amount to fill that in later. We have some extra information from the income statement, which is there is a loss on disposal of land of 18,000. So we can put this into the journal entry. So debit loss on disposal 18,000. Land, if we're told in the additional information it costs 60,000. So we credit land in this journal entry. To solve the amount of cash, it's the loss on disposal minus the land. So this will give us proceeds of cash of 42,000. So we can put this into our cash flows and investing activities section. Proceeds from sale of land, 42. Next, we want to work out for buildings. Buildings, we've had some being sold during the period. We want to work out, had there been any proceeds? So we're told in additional information, buildings with a cost of 89,000 and accumulated depreciation of 43,000 were sold. We also got the information in the income statement that buildings, we had a gain of 31,000. So we need to do the journal entry for the sale to calculate out the proceeds. So the first line will be debit cash, and we leave a missing amount. We're going to calculate that. We're going to debit accumulated depreciation for 43,000. We're going to credit a gain on sale of buildings, 31,000. We're going to credit that original cost of the building, 89,000. So we add together the two credits, the gain on sale and the original cost, and minus the debit entry of accumulated depreciation. This gives us cash of 77,000. So we can put this into the investing activity section as well. So we put in proceeds from the sale of buildings, 77. Next, we can have a look at investments. So in investments, we are not given any additional information. We can make an assumption that any increase or decrease during the period will result in, it's because of a cash sale or a cash purchase. So during the period, the investments account increased. So we take the closing balance minus the opening balance, and this is going to be cash paid for the purchase of investments, and it's for 45. So we can put that into the cash flow statement. Cash paid for purchases of investments, 45. Next, we can have a look at what cash outflows did we have for the purchase of land and the purchase of buildings. So we start off with land. So we were told that we've got our land account, we've got a revaluation, but we want to determine, have there been any purchases during the period? We can only estimate this by doing the T account for land. So remembering that revaluations are not for cash, but if we determine if there's been any additional increase in the land T account, we can assume this is a purchase for cash. So we set up the land T account, we put in the opening balance from the balance sheet of 149. We put the closing balance on the credit side, 172. Then on the credit side, we're going to have the write down due to the sale. So we put the 60, which is that original cost of the land disposed of. We can also put in that revaluation. And so we're told that some land was revalued. So we need to reconstruct the revaluation reserve account. So revaluation reserve, we get the opening closing balances from the balance sheet. Opening balance 17, closing balance 32. We put in the bonus issue. We're told about the additional information onto the debit side. It reduces that account. So the debit side comes to 47. So minus the opening balance of 17, this gives us an upward revaluation of land of 30,000. We can then put this into the land T account. We put that in on the debit side, revaluation of 30. So now we can determine whether there's been any purchases for cash. So if that's the case, there'll be an imbalance on the debit side. So we total up the credit side, it comes to 232. The debit side will be the same. So minus the opening balance, 149, minus revaluation 30. This gives us purchase of 53. So we can assume that this purchase is for cash. So we can put this into our investing activities. So cash paid for the purchase of land, 53. Lastly, we need to check if there's been any purchases of buildings during the period. So we set up the buildings T account, put the opening balance of 225, closing balance 186. Then we put in the write down due to the sale. So the original cost of the building was 89. So 89 plus the closing balance 186 gives us 275 total credit side. So minus the opening balance 225. Then so it appears that we have had a purchase for cash. So we've had a purchase of 50 of buildings for cash during the period. So we put into our investing activities cash flows, the cash paid for purchase of buildings, an outflow of 50. So we total up all of our investing activities, it comes to an outflow overall of 29. So next we can look at the financing activities section. So in financing activities, we're interested in non-current liabilities, so things like mortgages. We're also interested if there's any current liabilities, like a short-term loan. We're interested in our equity accounts as well. Have we paid any dividends to our shareholders? And also our share capital account. So have there been any share issues for cash? So financing activities, we're going to start with a mortgage account. So we've got a mortgage debenture in the balance sheet. So it started with an opening balance of 0. We can set up the T account. It has opening balance 0 and a closing balance 75. So the missing amount on the credit side will be cash of 75. So we can put this one into the financing activity section. So proceeds from mortgage, 75. Now we can look at the share capital account. We're interested, have there been any share issues for cash during the period? So we set up the share capital T account, opening balance of 420, closing balance 491. Now we did have a bonus issue during the period that was not for cash, but we need to put that in. We put in the bonus issue on the credit side, 15. So we can now solve, did we have any share issues for cash? So that's the closing balance and the balance of the debit side, 491, minus the opening balance, 420, minus the bonus issue, 15. So the missing amount will be a 56 share issue. So let's put this into the financing activities section. So proceeds from share issue, 56. Now we want to look at the short-term loan. So there in the balance sheet, we've got short-term loan. So the opening balance will be on the credit side, 20. The closing balance will be on the debit side, 9. So this account has decreased over the period. That must mean we did a repayment. So 20 minus 9 gives us our cash paid on short-term loan of 11. So next we look at the bonds payable T account. So we want to see, did we receive any cash from bonds or did we pay any cash on these bonds, reducing this liability? So the balance sheet, we see that there's opening balance of 259, closing balance of 109. We pop those into the T account. And so our credit side of our bonds payable comes to 259. minus the closing balance of 109 gives us cash of 150. So we must have repaid bonds of 150. So we put in redemption of bonds, 150. And the final calculation we need to do is of the retained profits account. We want to find out how much cash we've paid for dividends during this period. So we need to reconstruct retained profits. We're going to have on the credit side opening balance 292, a closing balance of 330 on the debit side. We need to put the profit in from the income statement. That's 114. So our credit side is going to be equal to 406. We need to be aware as well if there's been any increases or decreases during the period of any of our reserve accounts, they're likely to have come from any of the retained profits. So general reserve account, you can see in the balance sheet, has increased over the period. This must mean that we have made a transfer from retained profits. This is the only explanation for why general reserve account has increased. So let's reconstruct the T account of general reserve. So we put 29 as the opening balance, 78 as the closing balance. So the missing amount on the credit side will be 49, and it's a transfer in from retained profits. So we can put this into our retained profits account on the debit side, so because it decreases retained profits. We can put this in as 49, and now we can solve if there's been any dividends paid during the period. So we've got our credit side equal to 406 minus closing balance 330 minus transfer to general reserve 49. So yes, we've had a dividend paid during the period. So that dividend paid is 27. So during the period, we must have closed off that dividend account. So we would have had a journal entry to record that we've declared the dividend. So debit retained profits 27,000, credit dividends payable 27,000. During the period, we've paid the dividends. So we debited the dividends payable account 27,000 and credited cash 27,000. So we're going to put in as our last line in financing activities, cash paid for dividends 27. We can add up our financing activities section and it comes to an outflow of 57.
Here's what the full cash flow statement will look like once you finish this particular worked example. Thanks for watching this video, and if you're interested in looking at a further cash flow video, I also have a financial statement that's prepared under the indirect method. Thanks for watching.